I'm joined today by Gareth Abley, co-head of alternative strategies at MLC Asset Management. Gareth is among the incredible investors sharing insights at the Private Credit Investment Forum today. Welcome, Gareth. It's great to have you with us.
Great to be here.
Can you start by sharing what are some of the unique features that make insurance-linked securities an attractive asset class for institutional investors, especially in the context of diversifying portfolios?
Great question. So I think there's a number of characteristics that are really distinctive. So I think we've been doing research on alternatives for 20 years. And in that time, there's very few asset classes or strategies that provide the same level of uncorrelated returns as ILS does. The reason for that is actually really simple. So the performance is driven by natural catastrophe events such as hurricanes or earthquakes, which can cause losses, but you get paid a premium for taking those risks, which at the current point in time is extremely attractive. So on our portfolio, just as one example, there's a 15% no loss return for a 3% expected loss. So there's a 12% net return, which for something that's got a zero correlation over 20 years with equities, we think is super attractive. So that would be probably the most important key feature. And then some of the other subtleties that are interesting. One is that the level of risk in the portfolio can stay pretty constant through time, but what you get paid for taking that risk can vary enormously. So the reason for that is the level of the spreads or the yield you get is driven by essentially the kind of historic losses that the industry has experienced, both on reinsurance, but also sometimes on the asset side of the balance sheet of reinsurance companies. So they invest in a levered fixed income portfolio. So if you have negative performance as we did in 22, there's capital destruction on the asset side, coinciding with capital destruction from catastrophes on the liability side. So that created a real dearth of capital. So that was one of the catalysts for spreads becoming essentially 2.5 times as wide as they were in 2017, even though the risk is essentially the same. So from our perspective, there's no other asset class that's like that. In equities, if PE multiples are wide, it's usually because things look good. In high yield, if spreads are tight, it's usually because things look good. There's no free lunch, whereas this is kind of an asset allocator's dream because you've got flat risk, but spreads vary, so you can kind of dial up or down based on how attractive it is.
What drives the positive expected return in insurance-linked securities? And what are some of the key risks investors need to be attuned to?
Yeah, so it's an interesting asset class. And I think it's something that everybody who has a home or kind of knows about home ownership will be attuned to. So a lot of us will have experienced rising insurance premiums in the last few years. So when we pay an insurance premium for our home, it's because we're essentially trying to hedge the risk that something really bad happens. We want to kind of sleep at night, hedge the risk of ruin. And to do that, we have to essentially pay over the odds to insurance companies relative to the probability of something bad happening so that they can make enough of a profit to justify being in business. Now, the insurance industry itself makes money by spreading that risk. So they insure not just me, not just you, they insure tens of thousands or millions of people. So they can probabilistically know that on average, say 3% of people will have an incident in a single year. But the one risk they can't diversify away is the risk of a big natural catastrophe event, whether it be a wildfire in California or a hurricane in Florida coming in and wiping out a large swath of houses in the same year. So they then look to the reinsurance market to step in and provide reinsurance, which is insurance of insurers, to take that risk of big natural catastrophe events. And that's where the opportunity is for investors. So what we call ILS or insurance-linked securities co-participate in the risk sharing with the reinsurers. So the reason why we're getting paid is because the individual overpays relative to the probability of loss. The insurer is willing to overpay relative to the probability of loss because it de-risks their balance sheet and their earnings volatility. And we can essentially harvest that risk premium as investors. So that's your first point around why does the return exist in a structural way and a sustainable way. The risk that investors need to be aware of is really the risk of loss from natural catastrophes. So that's the risk that we're getting paid to take. Now, one of the good things about the asset class is if you contrast it again to, say, listed Aussie equities. In Aussie equities, you might have 100 stocks in the portfolio, but BHP is very correlated to Rio Tinto, Coles is very correlated to Woolworths, all the banks are pretty correlated. So superficially diversified, but it might have a correlation of like 0.8. Again, if you look within the natural catastrophe world, you can think that the Florida hurricane is completely independent of the California earthquake. completely independent of a Japanese typhoon. So you get a second layer of diversification within the perils within your portfolio. So you can build a portfolio that's diversifying to equities in itself, but then underlying exposures are diversifying to each other as well. So it allows you to build an attractive portfolio that can make money in most years, even though you do have this risk that a big, super big event can cause losses.
Could you explain the differences between public and private insurance-linked securities? And what unique opportunities does each segment present for investors?
I can, and it's a really important question for investors. So I think the easy and simple access point for most people who are new to the asset class tends to be public reinsurance, which is called catastrophe bonds. So they're essentially similar to kind of high yield bonds in the sense that it's a tradable security. You get paid a cash return and then a reinsurance spread on top of that, which gives you your coupon. So the benefits of cat bonds, it's kind of relatively liquid and it's got all eyes on it because it's a public security. So those are the main benefits. Private reinsurance is a much bigger market. So cat bonds have only been around since 1997. The reinsurance market has been around for a long time. People like Swiss Re, Munich Re have been around for well over 100 years. So it's a much bigger, deeper, more diversifying market. The other thing about the reinsurance market that's a little bit more subtle but really important is within cat bonds, you invest $100 and you'll take $100 of risk. The reinsurance business model is essentially they run leverage balance sheets. So they might have $100 of capital, but they're able to write $500 of risk against that capital because they're writing lots of different perils. So that means they can build a more diversified, more capital efficient portfolio that potentially has better risk adjusted returns. And one of the things you can do in the private reinsurance market, which we've been doing for many years, is what's called quota shares or sidecars, where you essentially invest alongside the balance sheet of a reinsurer. So you only put $100 at risk as the investor, but you're essentially able to access leverage through the reinsurer who takes that tail risk on balance sheet. So not only do you get the benefit of the capital efficiency and the leverage, but you also get the benefit of being fully aligned with a reinsurer. They're taking the risk on the balance sheet, so you know they like the risks. And then you as the investor are essentially working with your capital alongside the reinsurer. So the benefits of private reinsurance, partly things like the quota share structure, partly a much bigger market. And also to some degree, private and public markets can zig and zag at slightly different times. So there are times when cat bonds, public markets can be more attractive. So in 2023, spreads were really wide. We dialed up exposure to cat bonds then to capture the wider spreads because cat bonds have some duration, which means you can benefit from yields coming in because you make a capital gain on the spread duration. And then sometimes private reinsurance can be more attractive. So currently, I think our portfolio shows that the private side is earning significantly more than the cat bond side. So we're much more overweight to the private reinsurance. So our view is ideally, if investors can, you have exposure to both public and private. So you can assess the best relative value and kind of dial up and dial down based on where that is.
So how would you rate the attractiveness of insurance-linked securities today compared to the last 17 years you've been investing in this space?
Yeah, it's been a fun 17 years. So it's an interesting kind of juncture. So I think we started researching the space in 2005. And for those with long memories, 2005 was a year of big hurricanes in the US. So Hurricane Katrina, which many people will know of, hit New Orleans. And there were also two other fairly material hurricanes in 2005. So spreads widened significantly as people repriced the risk of hurricanes. Now, we were lucky. We invested in 2007 because we saw that spread widening to really attractive levels. And I think I remember 2017, the yield on our portfolio was called at 15%. Now, we had probably 10 years after 2007 where there was very little natural catastrophe activity that impacted the industry and the space of ILS. So spreads gradually kind of cranked down. I mean, we still made money every year, but they were kind of lower. And then there was this essentially big change from 2017 to 2024, where in most of those years, we've had more than $100 billion of annual industry losses. Now, that was from a starting point of low spreads or lower spreads in 2017. So we have a more remote risk portfolio, so we still made money above cash every year, 2017 to 2024. But a lot of people, unfortunately, didn't because they were maybe taking more risk. But if you fast forward to 23, you'd had kind of like a number of years of these much heavier, more painful losses, a lot of capital exiting the space, climate change lurking in the background as a reason for people to stop allocating or deallocate. And as I mentioned earlier, in a different question, which was around the losses that people made on the asset side of their balance sheet, which was 2022. So reinsurers invest in fixed income portfolios on a levered basis. Bond yields rose. They made a lot of losses. That was combined with losses on the cat side. So spreads rose really materially in 2023. So they were extremely attractive, extremely wide as we've ever seen in the 17 years. They've come in a little bit over the last 2 years, but still really attractive. So if 2023 was a 10 out of 10, it's kind of an 8.5 out of 10 today.
What do you think are some of the key tricks to implementing a successful exposure to insurance-linked securities?
I think there's a number of things. So I think having the flexibility to invest in both public and private reinsurance is helpful, given the relative value changes through time. So I think that would be one. I think our view is it's better to play in more remote risk perils. So that means things that are only impacted by really big events. So there's two reasons for that. I think one is there's economic reasons why those perils pay a higher return per unit of risk, a higher multiple, and have done for a long period of time. The second is more subtle, which is that it's easier for stakeholders and investors to stay the course in the asset class if they're not losing money on a regular basis, which can happen in higher risk strategies. So I think there's probably, unfortunately, a lot of investors kind of exited or got stopped out of the asset class because they potentially took more risk, suffered losses, stakeholders lost the faith, and that meant they weren't there in 23 when spreads were super wide. So I think our bias is remote risk makes sense. And then probably the third key thing we would recommend is to diversify across multiple managers. So one of the interesting bits of analysis we've done recently is we looked at 15 different ILS managers, all taking ostensibly similar levels of risk. And we tracked their returns each year between 2017 to the end of 2023, which is quite a high loss year, which kind of pulls the curtain back on what's in the portfolio, and that can create more manager dispersion. The average difference between the best and the worst manager over those 7 years was 15%. So huge manager dispersion, and we regard that as essentially unpredictable. So it's driven a lot by luck, and it's driven a lot by things under the bonnet that are very subtle, that intersect in different ways, that are quite hard to work out ex ante. So our conclusion is if you want to capture the risk premium as reliably with as much certainty as possible, multi-manager is definitely a much more risk-return efficient way to do it.
Gareth, thank you. We're going to have to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Private Credit Investment Forum.
Thank you, Zelda.